Mounting economic pressures are forcing business owners to look for avenues to assess and free up cash flow. One such option has been in the form of a sale and leaseback transaction. It's an enduring strategy that causes minimal disruption. Subletting and sale and leaseback transactions are two of the most popular ways to free up cash flow tied up in commercial real estate. Joining us now to explain the advantage of these options is John Jack, CEO of Galetti Corporate Real Estate. John, thank you so much for your time. A pleasure speaking to you again. Now, unpack what exactly is entailed in a sale and leaseback transaction, particularly in the commercial space for us.
Yeah, I mean, a sale and leaseback transaction is essentially where the business owner sells the property that they own and occupy to an investor who then leases it back to them. But, you know, when you came on, you said we were going to explain the advantages. There are the advantages and disadvantages of the sale and leaseback. So I think it's important to get it right when you enter into a transaction like that.
Now, why is it important to think long-term rather than a short-term approach in such transactions, particularly looking at the advantages of this transaction?
So the leases are typically long-term in nature. So the best price you're going to get for your asset is when you sign a long-term lease and then sell it on the back of that long-term lease. So these transactions happen at exactly the same time. The lease is signed at exactly the same time that you sell the asset. And when you're entering into a long-term lease, you've got to very carefully think about what happens ahead, because as you know, you sign a 10-year lease, you escalate this lease year after year, and in the 9th, 10th year, you're in a situation where you could be paying a lot. So it's important to try and model your cash flows going ahead as closely to your business expansion as possible, so you don't land yourself up in a situation where you're effectively overpaying on rental. And this is a common sort of pitfall of a sale and leaseback transaction, where the business owner often tries to get as much as possible today in exchange for overpaying in the future, and that's one of the bigger issues when looking at a sale and leaseback for a business owner.
Now, you've explained the financial model, so to speak, of it. So a bakery owner sitting at home wants to free up some cash flow, as an example. So they would sell their bakery and then lease out that same bakery to the new owner. Is that exactly what it is and what it entails?
So typically, let's say the bakery in your example, they would own the building that they occupy and that they run their bakery from. They own the actual building. What they then do is they sell it to an investor. That's the actual building, and they lease that building back from the investor to continue the operation of their own business. So their business stays in the same place, but their asset moves from their own balance sheet to the new owner's balance sheet, and they become the lessee instead of the owner of the building at that time per se.
I would imagine that given COVID-19 and this time that we are finding ourselves financially and economically in South Africa, so to speak, it sounds like a very lucrative way to go. So how long can we expect sale and leaseback trends to continue well after COVID-19?
Yeah, I mean, I think they're definitely going to be around for the next few years. And largely it's about looking at what you can do to restructure your balance sheet. Often you've got business owners who've owned properties for 10, 20, 30, 40 years. In some circumstances, they've even owned them for the last 100 years. And it's about this asset sitting there. It's ungeared. They're looking for ways to release capital in their business. And this is one of the ways to do it at a relatively cheap option of getting that capital released from their balance sheet. You know, it is something to be considered, though, because, you know, over the long term, again, you are releasing an asset, and you can't do it too expensively for yourself. You don't want to end up paying too much in your lease where you've just kind of released this asset because you're under pressure. You want to get it right. You want to get the best value for your building, and you want to get the best value for yourself on a long-term lease. So they need to be there.
Now, can this process go pear-shaped, and how does one protect themselves from losing money in a shady deal, as an example?
Yeah, we've seen it go pear-shaped. A lot of the times it goes pear-shaped, and you know, typically and this is where investors are wary of sale and leasebacks. Often a sale and leaseback, when it's not structured properly, where it's not considered properly, is a business owner going, I need money, let's just do anything to get hold of it, and I'm willing to pay a rental which is way above what a typical market rental would be in order to release the maximum cash for myself now. So an investor will often go and look at the actual financial statements of the business to see that there's no significant trading pressure. They'll, in some circumstances, ask them to make sure that they retain the cash or that no dividends are issued out of the business. So the cash is retained for the business to strengthen the actual underlying business that's in operation. And where that business owner has just opted to get the most money out of their building as possible and sign the highest lease, often 3-4 years in, a business that was under pressure now gets under significant pressure despite the fact that they've unlocked some capital in the business. And that's really where people run into problems with sale and leasebacks. You need a good balance.
So this is obviously in the commercial space. What about the housing or the private space? What are you seeing there in terms of trends and how people are relieving themselves from economic pressure?
There you're going to see a sale, and people are downscaling their actual, their home potentially. You might be in a higher value home and you sell it and maybe purchase a lower value home, thereby releasing some cash for yourself. Or alternatively, you might move to lease somewhere else, but people are typically downscaling in that situation. The difference with commercial is you're actually selling and then continue to operate from the same premises, whereas in residential, you're probably selling and moving to a smaller premises. That also might be the case, by the way, for a commercial transaction where someone sells their operations and just moves and finds a smaller space. We see that in the office market quite a lot, specifically now where people are looking to try and optimize their office footprint. They might say, well, we do see ourselves using an office into the future, but we might not use it the same way as we've been using it historically. So people might say, well, let's not be as panicked about getting our entire workforce into the office. Let's make sure that people, come to the office, interact, engage, build a culture, take the business forward. And so there's definitely space for office, but people are just going to use it differently. So therefore, your 1,000 square meter office, you might only need 800 square meters, 700 square meters going forward. And that's where you actually find people selling their space and moving to a smaller space. And as much as a 1,000 square meter users is moving to 800 square meter, so a 1,500 square meter user is moving to 1,000 square meters. So there's lots of transactions and sort of staging down in the market. And on the other hand, there are also people getting bigger and bigger. It depends on what sector you're in.
Now, John, because people are so cash strapped, can they actually do this alone without getting a professional service, to assist them with these transactions? Obviously, being very mindful of some shady dealings that may transpire, or you getting yourself locked down into a long-term business deal that doesn't actually serve you.
Look, you can. It's the underlying transaction simple. You sell your property and you lease it back from the new owner. So the fundamental transaction simple. You can put it together by yourself. What you're not doing in that situation is establishing some form of sensitivity analysis. What happens if we sign a 5-year lease? What happens if we sign a 7-year lease or a 10-year lease? Could we attract more value for our property? And what's the best sort of where does the rubber meet the road here? What's the best value we're going to get for the shortest possible lease? And at the same time, let's make sure that we've benchmarked ourselves back to market and we're not paying a significant rental that that we wouldn't be able to achieve a better rental anywhere else. At the same time, are we using the property functionally, or is it too big for us? Are we just leasing it back because, see the tree, hit the tree type of mentality? So all of those things are ticked off when you work with a professional, and that's across the board. You could be working with a legal team. You could be working with a corporate real estate advisory such as ourselves. You could be working with your accountants. There are a lot of people who understand these structures, and I think at the different levels add different values. And so yes, you can do it by yourself. Should you do it by yourself? It's probably not the best idea. And the last thing is, of course, you want to cast a wide net in terms of investor and make sure that you get the best price for your building as possible, because you only get one shot at this transaction, so you want to do it right the first time.